So you're running a business here in New Zealand, and like pretty much everyone, you've probably bought something, a car, a laptop, maybe even a building, that you use for both work and, well, for your life. On the surface, it seems simple enough, right? But come tax time, this is exactly where GST adjustments can get super confusing. Today, we are going to untangle all of it for you.
I mean, this is just the reality for most of us, isn't it? The line between work and home is blurry, and so is the way we use our assets. This is precisely why GST adjustment rules exist. It's all about making sure the tax you claim is a fair, honest reflection of your actual business use.
And to make this really easy to follow, we've broken it down into 5 key parts. We'll kick things off with the core problem, then jump into when you actually need to make an adjustment. After that, we'll cover the rules for everyday goods, what to do when you sell something, and finally, we'll touch on some of those tricky special cases, like land. Let's dive in.
Okay, Section 1. Let's tackle the biggest question first. Why do we even need to bother with all this in the first place? Well, it all boils down to one simple, really powerful idea.
And here it is. Seriously, if you remember only one thing from this whole explainer, make it this. You can only claim GST on the part of an asset's use that helps you earn business income. That's what the IRD calls taxable supplies. Literally everything else we're about to talk about flows from this one single principle.
Think of it like 2 lanes on a highway. In one lane, you've got stuff that's used 100% for business. Say, a dedicated tool in your workshop. You claim all the GST up front, easy. But in the other lane, the mixed-use lane, you've got that car or that laptop. For these, you make an initial claim based on your best guess of its business use. But since life happens and that use can change, you might need to make adjustments down the road.
Okay, so we get why adjustments exist. Now for the really practical question. When do you have to do them? And here's the good news. You don't have to do this for every single paperclip you buy. There are some really important thresholds you need to know about.
You know, the IRD has some sensible exceptions here to stop us all from drowning in paperwork. You can totally skip the annual adjustment if the item costs less than $10,000, excluding GST. And for the pricier stuff, you're also off the hook if the change in business use is pretty minor. We're talking less than 10%, and the GST amount involved is under $1,000. It's all about being practical.
So for those assets that do cost more than 10 grand, how long do you have to keep an eye on them? This table lays it all out pretty clearly. The logic is actually quite simple. The more expensive the asset, the longer you need to monitor its business use. So something between $10,000 and $20,000, that's 2 adjustment periods. But something over $500,000 or any piece of land, you're looking at 10.
Let's make this real with a quick story. Meet Ben. He buys a car and estimates he'll use it for business about 80% of the time. So he claims 80% of the GST. But a year goes by and he realizes, hang on, I'm using this thing 100% for work now. So in the next GST return he files after his business's year-end, what we call the balance date, he just makes an adjustment to claim that missing 20%. See? It's just about correcting the record to match what's actually happening. All right, let's talk about those common, less expensive things we all buy for our businesses. For goods that fall under that $10,000 threshold we just mentioned, you actually get to make a pretty important strategic choice right when you buy them.
You've basically got 2 paths to choose from. Path number 1 is the principal purpose method. You just ask yourself, what was the main reason I bought this? If the answer is for business, boom, you claim 100% of the GST. If not, you claim 0. The huge advantage here is simplicity. You make the call once and you're done. No more adjustments. Path number 2 is apportionment, where you get precise, calculate the actual percentage of business use, and claim that.
And this example just illustrates the difference perfectly. Phil's new laptop is almost entirely for work, so the principal purpose method is a no-brainer. He claims the full GST amount and saves himself a ton of admin time. Amy's car, on the other hand, is mostly for personal stuff. For her, the apportionment method is way better because it lets her claim that 10% business portion of the GST, which she'd otherwise miss out on completely.
Okay, let's move on to what happens when an asset's life in your business changes for good or, comes to an end entirely. This is where you'll hear the terms wash-up and final adjustments.
A wash-up adjustment is basically a one-off calculation you do when an asset's use changes permanently. So imagine a car that was 50-50 business and private use is now going to be your full-time delivery vehicle. You do this one-time calculation to true everything up. And the best part? No more annual reviews for that asset. You're done. And then there's the final adjustment. This one happens right at the end, when you sell the asset or just stop using it in the business altogether.
This calculation is literally the last step that squares the books, making sure the total GST you've claimed over the asset's entire life perfectly matches its total business use.
Let's look at Melissa. She bought a car, and based on our mixed use, she claimed 70% of the GST she paid on it. Later on, she sells the car for $30,000. Now, because she didn't claim 100% of the GST in the first place, she has to make this final adjustment. There's a formula for it, of course, but what it does is let her account for that 30% she never claimed, making sure her total GST position is correct over the whole time she owned the car.
All right, we're on to our final section. Now, this is where things can get a little bit tricky, but stick with me, we'll make it simple. Let's cover a few of the more unique scenarios, especially land, because it really does have its own set of rules.
Yeah, land can be a real headache. Take Lee's situation. She buys a property to do up and sell. That's a business activity, and you'd normally claim GST. But then the market takes a dip, so she decides to rent it out to a family instead, which is a non-taxable activity. So now, from a GST point of view, the property is being used for two conflicting purposes at the same time. This is a classic trigger for a special adjustment to fairly split that GST claim between the two uses.
And you know, it's not just about how you use an asset. Other things can trigger an adjustment too. For instance, if you have to write off a bad debt, you can claim a credit for the GST. But if you later recover that debt, you've got to pay that GST back. Barter deals, insurance payouts, they all can require adjustments to make sure the GST is always accounted for properly.
So, after all those rules, examples, and formulas, what's the big takeaway here? It really just comes down to one word: fairness. The entire system, as complicated as it can sometimes feel, is just designed to make sure that the amount of GST a business claims from the government is an accurate reflection of how much its assets are truly being used for actual business. It's a system of checks and balances, that's all.
And that really brings us to the final thought I want to leave you with. Now that you understand the principles, take a fresh look at your own assets. That car, that home office, that piece of equipment. Are your GST claims really lined up with how you actually use them? It's a question every single smart business owner should be asking. Thanks for tuning in.